to business. So we have a great crowd here, and I hear there's also a great crowd online. So welcome to our online viewers as well. My name is Erica Benson. I'm the director of the Office of Research and Sponsored Programs here at UW Eau Claire. And I have the honor of introducing our speaker, Dr. Dylan Howell. Dr. Howell is an assistant professor in the accounting and finance department here at UW Eau Claire. And as you can see, my head is probably blocking his talk title here: Non-Deal Roadshows and Mergers and Acquisitions, Value Effects, and Financing Choices. Now, before I turn things over to Dr. Howell, I'll note that we will have some time after his presentation for questions and comments from the audience. So I expect you to be thinking of some questions that you'd like to ask during the presentation. And to our online viewers, we invite you to use the chat or the Q&A function to enter your questions, and our wonderful graduate assistant and videographer, Matt, will read those to the audience. And I just asked Dr. Howell that when we do receive questions from the audience here, that he'll just provide a short summary for the benefit of our online viewers so that they can hear those. So please join me in giving a warm welcome to Dr. Howell.
Thank you, and hopefully I do leave time for questions. I tend to be long-winded. If you know me, you know this is true. Just a quick little backstory. So 2019, I'm a PhD student. I go to a conference at Texas Christian University. The first guy gets up and asks the question, "What's a non-deal roadshow?" And the entire audience just goes, "Wow." We've all heard of roadshows. As you know, finance people, we understand kind of how that works, but the non-deal aspect was something that really drew me in. And so I started looking into, what are they doing? What tend to be the effects of these meetings? And we're going to talk about what they are, ultimately the effects that they have, and specifically effects they have in relation to the event of merger or acquisition. So we'll start there, right? What are non-deal roadshows, right? These non-deal roadshows are just very simply one-on-one private meetings between these financial institutions and the management of a firm. And as the name kind of makes clear, they are non-deal. They are not supposed to be in relation to IPOs, SEOs, mergers and acquisitions, anything like that. They are just information gathering type of events. And it makes it kind of strange when you go, okay, well, it's private. So it's private information that is being dispersed. Why would they meet in this way? What type of effects would it have? Because ultimately, we know that when information asymmetries exist between investors and firms, then there end up being mispricings, there end up being all different types of market-related effects. And so I wanted to know, well, do these actually have spillover effects into some of the actual corporate ordeals, such as merger and acquisition? Now, again, these are voluntary. This is not something a firm has to do. They ultimately choose to do it with institutional investors, and obviously that can have significant effects. If you have something good to say about your firm, you can share it. If you have concerns that you want to share and you don't want it to be out in the public yet, you can share it. Now, that brings a whole nother set of issues because there are obviously disclosure laws. But again, this may ultimately bump up against some of those ideas. Now, this is a service that sell-side analysts, they will offer to institutional clients. Again, they're trying to match those institutional clients with those firms, again, in order to do their job in an efficient way. And then again, these are not mandatory, nor are they associated with the issuance of securities, which is important to note because the roadshow idea generally is, okay, we're going to go issue new shares somewhere. And so we want to go around to different investment banks, determine what they think our valuation should be, come to some determination, and then ultimately issue shares. And this is not that. So what's the motivation and goal of what we're doing here? Non-deal roadshows ultimately are really prevalent. We don't hear a whole lot about them, but they occur all of the time. And they are important mechanisms to convey information, albeit private information. But to me, that's what makes it all the more interesting. interesting is that it's happening behind closed doors, and opening up that black box becomes, a bit more interesting. Where are all these effects ultimately taking place? But again, since it is private, little is known, right? Little is known about what the exact outcomes are. And so ultimately, I want to get to the bottom of that, at least in these particular contexts. And then asymmetric information, we know, significantly affects M&A outcomes. Now, the reason for that, if investors don't know what the management of firms know, then coming to a determination of the value of a merged firm is going to be quite difficult, right? So unless we have symmetrical information on both sides, we're going to have a hard time ultimately coming to determinations of firm value. So with all this in mind, I seek to examine the value effects and the managerial choices. So choices of, how are we going to finance this acquisition? Things like that. What is the premium that we're willing to pay for this firm? And then how non-deal roadshows ultimately impact those types of decisions. So non-deal roadshows, then again, this is kind of at the crux of all this. I don't want to get lost too much in the mergers and acquisitions idea. This is just a channel through which we can determine the non-deal roadshows are valuable forums to convey firm-specific information, right? And so there's not a whole lot of literature out there when it comes to non-deal roadshows. Again, if they are private meetings, who is, determining what's actually happening within these meetings? The furthest back that you could find anything is 2005. This was an investor relations book. And the quote was, "It is the most effective forum to develop interest in a stock because portfolio managers can ask questions, look management in the eye, and share concerns in a private setting," which obviously sounds like a very valuable place to be, right? If you can, actually get the information from the horse's mouth, then why would you not do so? Again, the difficulty comes, what can you say? What can you tell one investor that you don't have to tell the entire universe of investors? Then this 2018 paper was particularly interesting because it got down to corporate flight activity. They didn't have non-deal roadshow data per se, but they tracked corporate flights. And they said, well, when did these CEOs, CFOs go to these, major financial hubs, New York City, San Francisco, Boston, Chicago, and did they meet with, were they on the schedule of any of those major investment banks? And if they were, ultimately it affected abnormal stock reactions to things like earnings announcements. It impacted firm value generally. And so that was a big piece of research. And then the 2022 paper here ultimately was the paper where all of this came from for me. That was the paper that I heard in 2019 being presented, ultimately got published in the Journal of Finance. And they found that institutional investors trade heavily and profitably around NDRs, which sparks interest. You go, well, if you're trading a lot and you're trading profitably, that tells me that you know something that others don't know, right? And so the idea that these meetings are just, relational, and we're just, trying to build relationships and have a good time and, get to know our investors, it kind of flies in the face of being able to trade heavily and profitably. And then they also talk about the analysts who sponsor these meetings. They create these, obviously the forecasts for earnings or price targets, whatever it may be, and that those price targets and those earnings expectations become way more beatable, right? The target prices, they are more optimistic. They expect them to be better, and then the earnings forecasts become beatable, which, as we know, the outcomes of earnings announcements often, what do you want to hear? Oh, they beat on earnings. They beat on revenues. Well, again, if they are creating these more beatable forecasts, well, of course, I'd want to meet with you. Of course, I would want to meet with those firms that would say, hey, we'll make it a little easier for you to have a positive market reaction to your stock. Again, it's very hairy, but it is very interesting when it comes to those informational effects. And then a paper I have that was just accepted in the Journal of Behavioral Finance, I talk about the earnings announcement outcomes, right? And the post earnings announcement drift. Typically, what will happen is if you have a good earnings announcement, then the stock price will continue to drift in the direction of that outcome. So if you beat earnings, then your stock will continue to drift upward, and then the opposite also being true. What I find though is that when there's NDR activity, non-deal roadshow activity, it reduces this effect, meaning that instead of drifting in the direction of the earnings outcome, instead the information gets priced in more immediately, and the stock price is already found. This is what the stock price is supposed to be, instead of the market trying to determine what it should be over the course of the next quarter or so. So again, non-deal roadshows, limited literature, but the literature does do a lot in the way of motivating this paper specifically. Now, when it comes to mergers and acquisitions, the application here, I think, becomes very clear. We start with just the idea of announcement returns, because I ultimately want to know how does having non-deal roadshow activity affect the announcement returns of mergers and acquisitions? Because in the same way that you have an earnings announcement and there's a big effect there, there will also be some significant effect, hopefully, around the announcement of a merger, where you expect value to be changed for acquirers and targets. So what is found in the literature is that acquirer cumulative abnormal returns tend to be negatively related to asymmetric information. Again, not surprising, because if investors don't have the same information that the firms have, then ultimately that is going to affect the acquirer significantly. Because what is typically the case when a firm announces a merger is that the acquirer is going to have a negative market reaction, and the target obviously is going to have a significant positive reaction, because typically those target firms are smaller firms, maybe even private firms that are being bought by these larger firms, and typically bought at a premium to what they are actually worth. So they have these major significantly positive reactions, but the acquirers is typically negative. Well, if we know less about the acquirer, if there's more asymmetric information, then we would expect the acquirer returns to be even less, because again, we don't know if that was a good decision, the merger, or not. And then the 2017 paper here shows that acquirers of more opaque targets, again, targets that we know less about, realize higher returns. And this is interesting, particularly because the acquirer can bring to light the information about the target. So that target can end up having some significant positive market reactions that, again, are in relation to the announcement of the merger generally. And then target private information. And this, again, we're kind of making the progression here towards information asymmetry, private information. Target private information has been shown to be a significant driver of positive target merger announcement returns. So again, if there is more private information about the target, and then they are ultimately acquired, and there tend to be some really major positive announcement returns. And again, why would this be? It would be because if I knew enough about the target to make a determination beforehand, then the price would already show what I expect the target to be worth. Instead, we don't know everything we need to know about the target. Thus, upon the announcement of the merger, everybody goes digging. And they're like, oh, this is why, this is why, this is why. And they're buying up the stock, and thus having a more positive announcement return. And then when it comes to financing choice and bid premium, the idea tends to hold. Now, with the financing of a merger, typically these are either cash financed, stock financed, or some mixture of the two. With a stock finance merger, ultimately all of the risk falls on the shareholders of the acquirer, right? Because you are issuing new shares to the target shareholders often, in order to do what? In order to have access to the firm. So if you don't know much about that target, and you are going to issue new shares, issuing new shares is not something to scoff at, right? Especially if this is a significant size firm. So you would want to know as much about that target as possible before you ultimately issued new shares in order to purchase them. If not, the value effects on your firm could even be further in the negative direction. So bidders with private information try to benefit from their informational advantage by offering stock when they are overvalued. And this is a common outcome, right? Firms issue shares to finance operations, often when they perceive their stock to be overvalued in the first place. And then the greater extent of asymmetric information faced by an acquirer in evaluating its target, the greater likelihood of a cash offer. Now, this is particularly interesting because if we don't know much about the target, but we are willing, and when I say don't know much, the acquirer is going to do their due diligence, right? It's not that we don't know anything about the target, but when there is still some opaqueness, some some barrier between what they know and what we know, but I feel like it's a good acquisition to make. That acquisition is more likely to be just a cash offer. Again, because if I have the cash to go do something, that is less risky than me going and issuing a bunch of shares, putting my shareholder value at risk, right? Shareholders would be much more perturbed by the idea that you issued new shares, thus reducing the value of theirs, and invested in something bad than if you just took cash and invested in something bad, right? So that's not particularly surprising either. So then we have just the bid premium, and the bid premium is a simple idea. This is how much you are paying for the target above what the target's market price ultimately is. And so what is found is that target private information and acquirer disclosure are both going to drive lower bid premiums. And so the reason for this would be, if I know more about the target, I am less likely to overpay for them, right? I'm going to try to pay as close to the actual market price as possible. Okay, so that's, again, some of the background of this. I want to try to lay that out as clearly as I could. When it comes to non-deal roadshows, the question may be, okay, these are private meetings. Where do you get the information? Where do you get the data, right? In order to do some analysis like this. There is a website that is a subscription-based financial news website called thefly.com. It used to be the Fly on the Wall. And they publish real-time financial news. This has been used by a few papers, one of which is in Journal of Financial and Quantitative Analysis, and the other in Journal of Finance. And the difficulty is that this is not easy data to collect. As a naive PhD student, I go, well, let's go and let's collect some data and let's have a good, and it took hours and days and weeks and months. But ultimately, it turns into papers like this one. So what do they give you? They rely on several non-public sources, leaks from brokerage firms. Some brokerage firms actually give them their schedules of non-deal roadshows, because you still don't know what's going on within those closed doors, but you do know that those events are occurring. And it offers the same, the name of the company involved in the meeting, where it occurred, which brokerage firm sponsored the NDR, and I have all of these that were reported between 2013 and 2020. So this would be just a singular data point, right? You have December 9th, 2019, AT&T is meeting with UBS, they're meeting with the CEO of AT&T, and they're meeting in New York City, right? So that would be the type of information that I had. Notice it doesn't say, what did we talk about? It didn't say, what's coming up? Why would you want to do this? It doesn't say any of that. So again, that keeps the black box closed, at least for now, but it raises more questions in my mind as to, okay, well, you're doing this. Why? You're not wasting your time. So just some basic descriptive statistics when it comes to the NDRs. Again, I told you these are super common. Number of NDR meetings per year. Again, we're looking in the 5,000-6,000 range. 2020 was a little lower. A lot of them went virtual. That's more research for another day. But over the course of the 8 years that I have here, over 49,000 total meetings, firms that engaged in them, over 4,500 with almost 140 brokers. So again, this is not uncommon. So then the question becomes, well, why don't we hear about them? Well, we're not operating in these institutional circles, right? And again, if they are private, they probably want to keep them that way. I would like to know as much about them as possible. But common firms that actually engaged in these kind of span different industries. There's really no rhyme or reason as to the firms that do it the most often. But the sponsors, the sponsoring brokerage firms, the investment banks, these are all the big ones we've heard about. We've got JP Morgan's, Deutsche, Piper Jaffray, Roth, Stevens, UBS, like all these big names. These are the places that they're going and meeting with these large institutional investors. Now, the M&A sample, I had to match this up with the Non-Deal Roadshow sample, given that it is a limited sample of 2013 to 2020. I did the same for the M&A sample, got the M&As themselves from the SDC database, excluded some of them just following literature generally. The really small transactions, it's going to be very difficult to determine outcomes. So the value of the transaction had to be over $1 million. I ultimately wanted here there to be a full acquisition, a full purchase of the firm. So the percentage of the target owned after the transaction was to be 100%. The acquirer owned none of the target prior to the transaction, because sometimes they'll buy up pieces of companies over time. So I wanted it to be a full acquisition, and then excluded a lot of these special cases, spinoffs, reverse LBOs, REITs when REITs are buying up specific securities. So didn't want that. Got the price and returns data from CRISP, financial and accounting data from CompuStat, IBIS for the analyst coverage and forecast, which is quite important because I wanted to also control for and know ultimately what decisions were these analysts making. Like we saw with the Bradley paper, if analysts are making their decisions and saying that, oh, we're going to make this more beatable for this firm, we're going to make more optimistic target prices, then I want to have that controlled for as well. What do we end up with? We end up with a public to public merger sample. So 2 samples, public to public, meaning I had a public acquirer, a public target. The public acquirer bought all of the public target. And I have a public acquirer only sample where you have a public acquirer that bought a private target. Now, something interesting about the NDR data is that some of the firms within it are private firms as well. So I actually got to employ some of that in this sample, and we'll see that later. Now, within the public acquirer sample, 2,000 of those 5,500 acquirers preceded the acquisition with at least one Non-Deal Roadshow meeting, right? So again, you may not have heard of this, you may not have known that these occur, but 2,000 out of the 5,500 is not insignificant by any means, right? And again, did so within 6 months of the merger, and then 150 of the targets did. So again, those are the private targets. That's a much smaller portion, and these smaller firms are going to have less access to capital markets, less access to these large investors as well. So here's a simple breakdown of the deals and the distribution of both the market value of the deals, the relative size of the deals, et cetera, over the time period of the research. A couple things to highlight here are that when you have a public acquirer and a public target, these tend to be much larger deals on average and in the median. The transaction values are much larger, and the acquirers are purchasing targets that are much larger percentages of the size of the firm than they are when you have a public acquirer that may just be buying a small, insignificant in the grand scheme of things target, right? And again, that also speaks to the number of acquisitions being so significantly different, right? If it's a bigger transaction, it's probably going to take longer, be more red tape. It's going to be more difficult to pull off than if you're buying a small private company. So what does this leave me with? What did I ultimately hypothesize based on the literature, based on some of these basic descriptive statistics? One, acquirer NDRs would be positively associated with their own with their own cars, meaning that if the acquirer comes out and tells me something in an NDR, it will mute the outcome that's expected. And the outcome that's expected is a reduction in stock price, right? So I'm expecting that will not occur in the same magnitude as it would if there were no private information previously. And then Similarly, acquirer NDRs being negatively associated with target cars. Why would this be? Well, if the acquirer comes out and tells me something about the target beforehand, is there going to be such a massive response to the announcement that this small target is being purchased on the back end? So I don't think that would be the case either. And that the association in each of these cases would increase with more asymmetric information. Of course, the less we know, the less investors know about the firm, there's going to be a greater magnitude of response to information that's brought to the market. And then with target NDRs, that they would be negatively associated with the bidder or the acquirer cars, and that the opposite would also be true. Again, why is this? Well, if I am a target and I come out and I tell you something about maybe an upcoming acquisition, we may be acquired by whomever, well, then what may happen is you'll come and buy my stock. You'll be really interested in my stock, so positively related with the target cars. But when it comes to the acquirer, they know there's going to be a negative announcement reaction to the acquirer, so they may jump ship a little early there. And then the acquirer NDRs having a negative association with the use of stock as a medium of exchange, as the means to purchase the other firm. And again, this goes back to if I know more about the acquirer, or if the acquirer comes out and tells me something, then that may have an impact on my willingness to put the shareholders at risk. And the shareholders may feel more at ease by the acquirer coming and saying, hey, we'll acquire this firm, and we feel really good about it. We're targeting this firm. And so that may increase the likelihood that we would just purchase in cash, not in stock. And then with the target firms, negative association with the use of cash as a medium of exchange, again, goes back to the asymmetric information and the stock cash decision. And then finally, and again, I think one of the more interesting, even though it's a smaller portion here, is that either of the firms, the acquirer or target, having NDRs will have a negative effect on the bid premium. Again, if we know more about the acquisition that's going to occur, then we're also likely to know that the acquirer is going to pay less. If they know more about the target, if the target knows more about them, then they'll be more aligned in what the value of the target should be, and the acquirer should ultimately pay less. And in some of the basic means and medians, we see that, right? We see the outcomes here for the cumulative abnormal returns. So what I have here is if the acquirer did not have an NDR, or if they do, if the target had an NDR, or excuse me, did not have an NDR, or if they did. And ultimately, what we see in the means is quite significant for the acquirers. They have an NDR, it reduces asymmetric information. There's a market reaction prior to the merger announcement. And so you end up with a more muted negative response as opposed to what would occur in the initial sample where you did not have an NDR in the first place. And with targets, you end up having this, again, if we have the target having an NDR, you end up having this negative effect on acquirer cars, but an extremely significant positive effect here. I mean, we're going from 14% positive return to a 21% positive return in the 1 day window, and then in the 2 day to 2 day window, we're talking over a 4% increase in target cars. Again, so just in the means and medians, this tends to hold quite well. So then we move to the regression analysis, and a few things here that I think are valuable to note. I'm saying we have the NDR of the acquirer, NDR of the target, and then this would be the situation in which both had an NDR. So what effect may it have if the acquirer and the target both came out and said something, okay? And then the controls here are pretty massive, definitely wouldn't fit. I control for a lot of the financial variables, return variables, leverage, size, all these different types of things when it comes to the acquirer and the target. And then I have a bunch of deal controls. So the relative size of the deal, whether it was financed in stock or cash, the size of the deal in gross, so what the actual transaction amount is. Another interesting thing here is we control based on, is it a hostile takeover? And because that may impact value determinations as well. And what I end up finding in the fixed effects regressions is that, yes, the acquirer having an NDR is going to positively affect their cars as expected. And then the target having NDRs, initially we're looking at a negative and significant effect in the 2 and 3 day windows for the acquirer. But the most significant and interesting is those 150 targets that I talked about before, those private targets that had NDRs significantly reduced acquirer cars when the acquirer was public and they were private. Again, what does this mean? This means that the target comes out and says, I don't know, could say any number of things. Again, it's a black box, but they come out and say something that indicates that this may be the case. They tip their hat to their institutional investors in some way, and the institutional investors jump the gun. They go ahead and create the reaction that they would have expected anyway. And again, that's same for the acquiring firms as well. Now, for the medium of exchange, it was a bit more ambiguous as to the outcomes. In the public to public sample, there tends to not be any super significant results. But again, in that public acquirer only sample, exactly what I expected to occur, we kind of showed. And we had the NDR of the acquirer. So again, the acquirer comes out and says something. It reduces both the likelihood of an all stock purchase and the percentage of stock that may be used. Again, it's not all stock or all cash. It could be a mix of both. So again, what does that tell us? It tells us that if the acquirer feels good about what they're doing, they tell the investors something, then the investors feel less at risk. And that is the outcome we ultimately see. The target, again, it just goes in the other direction. But again, that was consistent with the initial literature and the hypotheses that were raised. We can take all those initial results and go, okay, well, then what? Well, then what about the level of asymmetric information that the firm already has inherently? Because of course, we know more about some firms than others. So we want to control for that fact that we know more about some firms than others. And so this is a situation in which I controlled for the forecast errors of the acquirers. So the idea is the greater forecast errors from what the analysts expected to what the actual earnings are, then of course, the less the analysts actually knew, right? So this would be greater asymmetric information. So when we look at high acquisition error, we should be looking at this as greater asymmetric information in the way of the acquirer. And ultimately, what gets found here is consistent with what I expected previously, with us knowing less, again, high error, knowing less about the acquirer is going to have a negative effect on acquirer returns when both the acquirer and the target come out and say something, right? And those initial results on the NDR of the acquirer only hold in the 1 day window, in which, again, mutes that result significantly when we know less about the acquirer. This is a very similar outcome. Here I'm controlling for the idiosyncratic volatility of the acquirer stock. Again, a similar outcome. Higher illiquidity. So I use the Amahud illiquidity measure. Higher illiquidity, meaning we know less, we're interested less in the acquirer as investors overall, has that same type of negative outcome on their cars. And then this, I think, is particularly interesting, firm complexity. So if a firm has a high amount of intangible assets, that's often an indicator of high firm complexity. It's been shown in several papers. And the outcome here is neat, because if you have the acquirer come out and say something about themselves when they are a highly complex firm, then what does this do? This reduces the target positive returns, which I think is particularly interesting because these targets that are getting these massive positive returns from being purchased, well, now we know something about you and this deal that we wouldn't have known otherwise, and thus it mutes the outcome there. And then the acquisition bid premium, again, what happens? If we know more about the acquirer, then the gap between what they paid and what they should pay is going to get smaller, right? They're going to pay a more fair price for the target. And again, that's what we see with the 1 week and 1 day bid premiums there. So, conclusion to this, I find that NDRs by acquiring firms have a positive association with acquirer merger announcement CARs, and some evidence suggesting that acquirer NDRs reduce target firm CARs. Remember, that was just in the 2 and 3 day windows. And then target firm NDRs have a significant negative relationship with only the merger announcement CARs of acquiring firms. Acquirer NDR meetings are associated with a decrease in the likelihood of all stock acquisitions, and the opposite is true for targets. And then information disseminated in NDRs generally, but specifically by acquirers, is negatively associated with the acquisition bid premium. So in summary, what? NDRs are informational events that have value, and specifically have value in situations where there are deals to be had, right? So even though some may argue that these are insignificant, that they're just relationship building, the effects are generally there to show that no, information is being disseminated in some way, and those informational outcomes are showing up in things like the merger announcement returns and the medium of exchange choice. What's next for this paper? I'm targeting financial management initially. I'm preparing it currently for submission there, and then backing that up with managerial finance if that doesn't work out. So, yeah. And I think I gave myself 3 minutes. So there we go.
Is there a fuzzy line between NDRs and insider trading?
So a big part of the Bradley paper talks about Reg FD, Regulation Fair Disclosure, which is basically saying if you tell one investor something, you've got to tell everybody. And without saying it, I make the argument that that's not really the case, right? Again, some of the legal ramifications are weird. And I think there's just, I don't know, a lot of these institutions that have a lot of pull, and if you can't prove it, it didn't happen. So, you know. And again, I think that's what makes the non-deal roadshow I did the most interesting, because if we knew what was being said, we knew what was being disclosed, then, you know, we could wipe our hands of it pretty easily. The fact that we don't means that we can test a lot of things, or at least is not available to the market yet, which again, if, you know, there's really no difference between being late and being wrong in this case. Information regarding what went on within the NDR, there's no knowing. We don't know. All we know is that they met. Correct. We know that they met. And kind of where this goes from here, for this coming summer, I'm collecting more of this data now because there's more of it available. And I'm going to look into what some of these virtual meetings have, how they've impacted things, because the COVID reaction post 2020, and there's a lot of, again, if we're making relational arguments here, we're going to see if there are actually some relational effects in the longer term when it comes to meeting with these institutions or not, or if they are, you know, these pure information producing events. But again, I think the black box of it all means that we can look at all these different corporate events and corporate outcomes and say, what effect may it have here, you know? Because again, they're kind of all over the place. The most, and I will say this because it's not in this paper specifically, most NDRs occur post earnings. And so again, because they're trying to toe the line with Reg FD, but the issue is there's still a significant number that happen closer to the next earnings announcement. And then it's like, okay, well, what are we talking about now? You know, but we don't know. So we try to find out, right? That's
So you had a number of different outcomes, financial outcomes. I guess if you were to want the reader or reviewer to take away one thing from the paper, I guess what is the key message that you're hoping to put across?
the message is that non-deal roadshows convey information and it mutes the common outcomes of merger announcements, right? Because the common outcome is big positive for targets, a little negative for acquirers, but we're seeing less positive for targets and less negative for acquirers, right? So I think that's the big takeaway.